Hey everyone, and welcome back to our UP PGT Economics 2013 Paper Solution Series. This is part 4, and in this explainer, we're going to tackle questions 31 through 40. If you've missed the previous parts, definitely go check them out so you're completely up to speed. All right, are you ready to put your economics knowledge to the test? Let's not waste any time and dive straight into our first question. So, question 31 is all about value-added tax, or VAT. Take a close look at the options. Is it applied directly on the consumer, or on all the stages between production and the final sale? Or maybe just the first or the last stage? Give it some thought. And the correct answer is option B. You see, that is what's known as a multi-point tax system. This basically means that tax is levied only on the value added at each stage of production. And the most important part is that producers get a credit for the tax they've already paid on their inputs. This very smart system solves the whole tax-on-tax problem, which we call the cascading effect, and makes the entire process way more efficient. Okay, our next question is on a very important budgeting technique. Who gave the concept of zero-based budgeting? Was it Musgrave, Keynes, Peter Fire, or Hansen? This is a factual question, but the concept behind it is pretty significant. The right answer here is C, Peter Fire. But what exactly is zero-based budgeting? Well, imagine starting everything from scratch every single year. Instead of just carrying forward the previous year's budget, every department has to justify every single expense from a zero base. The main goal here is to increase efficiency in public spending and to prevent wasteful expenditure. All right, let's take a look at a question on taxation now. Which of these things has a favorable impact from taxation? The ability to work and save, the desire to work and save, reducing inequality in income distribution, or growth in employment? Think about this one carefully. The correct answer is C. This really highlights a key function of modern welfare states. Governments use taxation, especially progressive taxation, as a tool to reduce income inequality. This means that those who earn more are taxed more, and that revenue helps to redistribute wealth throughout society. Question 34 is about the relationship between public debt and inflation. If prices are rising, what happens to the real burden of public debt? Will it increase, decrease, remain unchanged, or will it be uncertain? The correct answer is B. The real burden of the debt will decrease. So why does this happen? Well, inflation reduces the purchasing power of money. So the money that the government pays back in the future is actually worth less than the money it borrowed in the first place. In simple terms, inflation benefits the debtor, in this case, the government. Question 35 is about the methods of debt redemption, which is basically how a government repays its debt. So which of these is not a method of debt redemption? The options are term annuity, debt conversion, commodity tax, or capital tax. The correct answer is C, commodity tax. This is a method of collecting tax, not repaying a debt. On the slide, you can see some of the actual methods of debt redemption, like debt repudiation, where the government simply refuses to pay, debt conversion, where high-interest debt is replaced with low-interest debt, and capital levy, which is a one-time tax on wealth. This is a very classic definition-based question. If you subtract interest payments from the fiscal deficit, what is the remainder called? Monetary deficit, primary deficit, current account deficit, or revenue deficit? The answer is B, primary deficit. This metric is so important because it shows how much the government needs to borrow for its current year's expenses, leaving aside the interest payments on past loans. That's why it's considered a better indicator of the government's current fiscal discipline. Here's an important intersection of Indian polity and economy. Who constitutes the Finance Commission in India? The President, the Prime Minister, the Finance Minister, or the Governor of the RBI? Absolutely right. The answer is A, the President. This power is granted to them by Article 281 of the Constitution. Under this article, the President has to form a Finance Commission every 5 years, or earlier if needed, to recommend how financial resources should be distributed between the Union and the states. This question is from the 2013 paper, so it's asked in the context of that time. Who was the chairman of the 13th Finance Commission? The options are C. Rangarajan, Vijay L. Kelkar, K.C. Pant, or Raghuram Rajan. The correct answer is B. Vijay L. Kelkar. And because this is an older question, we've added some extra context for you on the slide. You can also see the names of the chairman of the 12th, 14th, and the recent 15th Finance Commission. It's important to remember all of these names. Now let's talk about the now-defunct Planning Commission. Which statement about it is correct? That it isn't defined in the Indian Constitution? That its members and vice chairman didn't have a fixed tenure? That members didn't need any minimum education? Or Are all of the above statements correct? The correct answer is D, all of the above. All of these things were true about the Planning Commission. This question also reminds us of a major institutional change. The Planning Commission, which was a non-constitutional advisory body, was replaced by Niti Aayog on January 1, 2015. And now for the last question of this part. Again, remember, the context is the 2013 exam paper. At that time, who was the governor of the Reserve Bank of India? In the context of 2013, the correct answer is A, Raghuram Rajan, who was the 23rd governor of the RBI. For your general knowledge, he was succeeded by the 24th governor, Urjit Patel, and the 25th and current governor is Shaktikanta Das. So that was our final question. Before we wrap up, let's do a quick recap of all the important concepts we've covered today. We revised the basics of VAT and zero-based budgeting. We saw how taxation can reduce inequality and how inflation affects the real burden of public debt. We also covered the concept of primary deficit, the role of the Finance Commission, the big shift from the Planning Commission to Niti Aayog, and some essential facts about recent RBI governors. Don't forget to revise all these topics thoroughly. These are core concepts that are often asked in exams. We'll be back very soon with part 5 of this series. Until then, keep learning and all the best.